Ladies and gentlemen, welcome back to another episode of Investing for the Common Man, the channel where we learn how to save our most valuable resource. No, not our money, but our time with short, concise, instructional videos. In this video, I'll be revealing my top 5 stock picks for the month of July. If you watched my June recap video just a few days ago, you know that in June we saw a much needed pullback and consolidation from the unsustainable pace of the rally that we saw in May. Most of the major indices posted modest gains of 1 to 2% in June, with the exception of the tech-heavy Nasdaq that outperformed, posting a solid gain of 5.3%. With the recent increase in virus case numbers, I think it's wise to take a modest step back from some of the reopening stocks that I picked last month, but that doesn't mean that I've flipped bearish on them. In July, I plan to take a hint from the momentum that we've seen displayed in the Nasdaq, and look at a few tech stocks without chasing some of the dangerously overvalued high flyers like Zoom and Tesla with ridiculous PE ratios well into the thousands. Before we get started, please do me a huge favor to support my channel by subscribing and hitting that like button for the YouTube algorithm. Alright, let's dive in with my first pick, back on my monthly watch list for a second time, Alibaba, ticker symbol BABA. Back in May, when this stock debuted on my watch list, I noted that Alibaba is a very compelling investment for the same reasons that Amazon is. Alibaba is a Chinese-based multinational technology company specializing in e-commerce and retail, but also competes in the cloud computing and digital media spaces. With Amazon achieving all-time highs in the stay-at-home economy, it stands to reason that Alibaba's business model will also thrive. The reason that Baba is making this list instead of Amazon is because of Alibaba's enticing PE ratio of 28 compared to Amazon's 138 PE ratio. Just in case you're a bit fuzzy on what a PE ratio is, the price-to-earnings ratio takes a company's current value and divides it by the company's earnings over the past 12 months. This number is essentially how many years of earnings it would take for the company to essentially pay for itself. So a lower PE ratio is obviously better. For more information on this, check out my video on stock valuation in my Investing for Beginners series. One of the reasons for this difference in PE ratio is that Alibaba stock has been depressed recently by international political concerns and scandalous headlines involving executives that have been let go from the company for inappropriate behavior. These scandals seem to be quieting down, and the stock is getting ready to test this key level of resistance at the $225 level. If we can see a breakout above $225, this stock could easily take out its all-time high, just $6 higher. At the beginning of 2020, the 5G trade was the coolest kid on the block, with investors rushing to many of the clear companies to benefit from this 5G technology upgrade cycle. In the midst of the pandemic, the 5G trade has been pushed to the back burner, with more pressing concerns on people's minds. For that reason, this month I want to watch Skyworks Solutions, ticker symbol SWKS. Skyworks is a semiconductor company that produces a myriad of the miniature attenuators, amplifiers, detectors, diodes, switches, etc. that go inside hundreds of different electronic products used every day across various industries such as home, industrial, medical, military, smartphone, tablet, and wearable markets. With such a broad market base and momentum building on the chart as investors look once again to future innovation, I feel confident adding this semiconductor stock with a respectable PE ratio of 27 and a dividend yield of 1.33% to my portfolio. My third stock pick is Nvidia Corporation, ticker symbol NVDA. This pick is a double-pronged approach. Most people think of Nvidia for their top-of-the-line graphics cards for high-powered gaming computers. I see demand continuing to increase for these beefy graphic cards, both from the increasing number of people using more technology and turning to gaming for entertainment in the midst of this pandemic, with virtually all live entertainment and social events canceled, as well as a burst in production of new high-tech games with gorgeous graphics and 3D worlds that are demanding more and more computing power to run at optimal settings. But the gaming side is only one reason for this trade. Nvidia also has other chip brands made specifically for artificial intelligence, designers, supercomputing, and automotive use. Several of these segments will also benefit greatly from the 5G upgrade cycle that we talked about in my last pick. I also like Nvidia because it will not be hurt significantly like Intel and AMD as Apple transitions away from those companies and starts making its own chips for its new ARM computers. When we take a look at the charts, Nvidia has enjoyed a nice run up and is starting to get a relatively high PE ratio of 69 and a low dividend yield of 0.17%. But in this tech-friendly market, I could easily see Nvidia making it over 400 per share in the next month or two. Taking a step away from the tech sector for some healthy diversification, my fourth pick for the month is Costco, ticker symbol COST. Costco is one of those long-standing, reliable companies with healthy profit margins that has handled this pandemic well with new social distancing guidelines and has made itself even more indispensable to the American consumer in the grocery and household staple sectors. Costco has paid a consistently growing quarterly dividend since 2004, with a current annual yield of 0.87%. Now that might not seem like a whole lot, but Costco has a history of paying out a hefty, special one-time dividend every few years in addition to its regular quarterly dividend. When we look at the chart, Costco has had a nice run up over the past few years, but it has been trading sideways in the last few months, establishing several very strong levels of support around this $300 range. Now, getting long Costco is never a bad idea if you want to add a quality, stable, and reliable name to your long-term portfolio. But for the month of July, my intermediate term strategy is to play this name by selling out of the money short put spreads, also known as credit spreads, below these levels of resistance. I'll be covering the nuances of the strategy soon in my Introduction to Options course. But the idea is to use any pullback in the stock to establish a neutral to bullish position that profits as long as the stock stays above our strike prices. My target level for these spreads is just below $295, so that I have several of these levels of support protecting my position. In my recap video at the end of the month, I'll let you know how these trades went and compare the performance of those positions to that of a simple long stock position. My last pick of the month is one of my favorite underrated companies, and that is restaurant franchise holding company Brinker International, ticker symbol EAT. I've covered this stock on the channel before, so if you've been a long-time subscriber, you know that Brinker International owns the Chili's and Maggiano's Little Italy restaurant chains, with a total of 1,650 locations. Both of these restaurants already had strong takeout followings and infrastructure in place before the pandemic. In addition, just 1 week ago, Brinker International launched an entirely new, low-cost, takeout-only restaurant chain with over 1,000 distribution centers practically overnight. The new chain is called Just Wings, and the wings are cooked and sent out from kitchens of pre-existing Chili's and Maggiano's restaurants in a delivery partnership with DoorDash. This entirely new restaurant will have practically zero new overhead expenses and create a brand new niche and revenue stream for Brinker International. This is exactly the type of creative thinking and innovation you want to see from the companies in your portfolio. And even with some states starting to roll back their reopening processes, I can sense that many consumers are sick and tired of cooking from home, and even getting tired of traditional fast food. So I think that Brinker will continue to survive and even thrive on its takeout model until restaurants across the country can reopen their dining facilities more widely. EAT stock has experienced more than a 200% rally since its March lows, but it still has almost 100% more to go until it returns to its historical trading range. This stock is incredibly enticing from a value perspective, with a PE ratio of 7.7 and an annual dividend yield of 6.28% at the current share price. This company has been consistently increasing their quarterly dividend for 8 years straight, so I feel confident that this company will do whatever it takes to continue that commitment to their shareholders. I'm not really trying to do anything fancy with this trade. The goal is to establish a sizable, long-term stock position at these levels and just hold indefinitely to collect those dividends and ride the recovery as long as it takes. If we see any pullbacks, I might sell a cash secured put or two to collect a bit of premium and possibly pick up more shares at lower prices. But when in doubt, keep it simple and buy quality companies at a good value. That's all that I have for you today, but I would love to hear your thoughts or maybe some stock picks of your own in the comments below. As always, please take a moment to subscribe and hit that like button. It costs you absolutely nothing and really will help this channel grow and allow me to spend more time making quality content for you all. Until next time, Keep calm, stay healthy, and happy trading.